Hello everybody. Thanks for joining me. I hope it's a beautiful sunny day where you are. It's miserable and rainy over here in, where am I? Ohio, Cincinnati. Yeah, okay, this is a very exciting time in the market. I'm sure many of you are sitting back and scratching your head and wondering what on earth is going on with this stock market. So today I hope to try and unravel a little bit of the complexity or confusion that surrounds it. This topic that I'm going to present to you today is market meltdown, and it is my favorite topic, and I've been talking about it now for several months. It's the only thing I've been talking about because I feel very passionately about where we are in the market and how critical it is that we cut through the noise into what is really going on. Where is the market headed, and how do we time that? How do we approach that? And so, of course, the problem with that question is that everyone seems to have so many different opinions. One opinion that seems to be pretty common, and I think this has probably been a common opinion for at least 6 months, is this market is so overbought that how are we at record highs in this economy? Who would agree with that? Who would look at the economy right now versus the S&P 500 and say, yep, the economy is better than it ever has been before. So S&P 500 should go higher and higher and higher. Who would agree with that? Actually, better still, who would not agree with that? So that is the problem with that is that, we've been hearing that for 6 months, and it hasn't broken down. So what's going on? Where do we go from here? And that's kind of what we're going to delve into today. We're going to try and cut through the opinions on the market and actually go to something far more measurable, which is the technicals and the quantifiable things that say where is the smart money going most importantly. Now, a quick disclaimer, as you can see, we'll be talking about live markets. We're going to be talking about live stocks. I think some that we're in right now, some that we're looking to get in. So, of course, full disclaimer, this is for educational purposes only. To start at the kind of the base level, the theoretical side of where we build our strategies from and how we approach the market with our students. The reason why most people fail in trading is because they don't take action. How many people have done this where you look at a great trade and you have a feeling that yes, that is a fantastic stock, you should buy that, or that's a great option trade, you should get into that, and then you kind of hum and ah about it, and you go to bed, and then you look at the market the next day and it's up 20%, and you kick yourself. Or worse still, you look at a stock, you think it's a great decision, and then you overanalyze it with 10 different indicators, put it through Stock Twits and Yahoo Finance, see what Jim Cramer's thinking. You basically overanalyze it to the point that you don't end up trading anything, or analysis paralysis, as that's commonly known as. How many people feel that they're in that spot? Because that is a common problem with traders is without a strategy we fail to take action. When we surveyed over 1,000 of the students that we've worked with in the last several years, what they felt their most common struggles were when they came on board at the beginning, they said it was these: knowing exactly when to get in and when to take profits, selling too early before a stock takes off, knowing when to limit losses and avoid holding on way too long, and ultimately having the confidence to execute. Even with advanced traders. I spoke with a lady 2 weeks ago. She's trading about $500,000 in the market, and maybe a bit less than that, maybe 300,000 in the market. She's been in the market 5 years. She had great success in the market, and so far, from what I could tell, she was still picking her trades 70% correctly, which by anyone's standard is fantastic win ratio, but she was losing money. And I asked her to show me her trades, and when she went through it with me, it became quite obvious, because what she was doing was she had all of these stocks that she had originally bought, that a lot of them were gold stocks. She bought at the highs, thought that there was no way these things could go down, and they did. They dropped 10, 15, 20%. She was underwater in a painful way. And the problem was, of course, is that she had no stop loss. She had no absolute exit plan before she bought the position that said, if this drops below this level, I'm out. The trade is invalid. The idea is wrong, for at least at this time. So because she didn't hold that, mentally she said to herself, well, now this isn't a trade, now it's a long-term investment. Who's done that? Who said that to themselves? See, and then of course, because she's so bad trade, she becomes gun shy. And then every time she gets a profit of 5, 10%, she sells it. And then watches it go 20, 30, 40% higher. And then she kicks herself for that. So basically, even though she's getting it right 60, 70% of the time, she's selling her profits at a 10% and letting her losses run 20, 30, 40. So you can see this is risk-reward ratio working against her. It's the complete opposite of what you're meant to do. And this is because of a lack of confidence, and that comes from having a lack of strategy. And this is, or a lack of rules, so that you can say, right, don't stop asking yourself, what should I do on this trade? Because that's the real, you've got to look at it, not from the not from the micromanagement standpoint, but from the macro management standpoint. Don't look at a trade and say, if I hadn't have sold it there, I would have made 10% more. Because what if that strategy that made you sell it there is what's ensured you from not having losses on 100 other trades? You know, you can't micromanage this strategy and change it based on every single individual thing that comes out. You've got to look at a rule system and say, what is the system that, even though I lose money on this one, I make money on the other 80 trades like it? You know, just to use the extreme example. And that's what we're going to go over today is systems, so we can stop worrying about whether we're right or wrong on an individual trade, and be something far more important, which is, are we making decisions by the rules? I never worry whether I'm right or wrong. I simply look at the chart and say, does this stock meet the rules, yes or no? And I'll have my checklist of 5 things, and I'll say, does it have this, does it have this, does it have this, does it have this, does it have this? If I say yes to each of those boxes, then I'm getting it, I'm buying it, or I'm shorting it. I don't want to know what they do as a company, most of the time. I don't care what Jim Cramer thinks of it, what my buddy next door thinks of it. If it meets the rules, that's the only adjudicator in a trader's decision making. And that's what we endeavor to teach. Because I love taking risks, but that is quite different from being rash. If the risk reward is in your favor, and you know that you're going to win 51 times out of 100, that is all you need to turn on the money switch. Because of course that's what casinos do. They can't guarantee whether they're right or wrong. They just know that they're going to be right more than they're wrong and make billions of dollars from us poor folk off of it. Okay, so let's get into things. There's a little introduction of how we think about things and what our strategies are about. So we're coming towards the end of the year, and the scenario that's setting up in the market right now is eerily similar. Same situation we had 12 months ago, if not much worse. So do you remember last year around this time, June, July? We had a pretty sharp and aggressive sell-off. This was the first time I ever hosted Market Meltdown, was July 26 last year, where we said to people, we're selling everything and we're buying puts, long-dated, out-of-the-money puts on about 12 companies. It turns out we were right, and a lot of those went up in the triple-digit returns. Then we took profits on those, and then around November, December, we hosted this event again, and we published what we called the Christmas wish list. I'll take this scary image off. We published the Christmas wish list, which was again based on the same indicators I'm going to show you now that warned that another drop was coming. And from that Christmas wish list, we also then selected a series of puts that we felt were based on the weakest companies in the market, that they would plummet. We were right again. And we now feel that we are nearing that same point. We feel that right now we are building in a bubble that is a planned exit for the smart money to get the hell out of the stock market. And that is what I'm going to focus for the next 10 minutes on, is how where the smart money is going and how they are exiting. Now, just quickly before we go into that, I'd like to get an idea from the audience of what everyone's feelings are of this market right now. Do you feel, and please throw your opinions up in the chat box, do you feel that this market is imminently going to crash? So imminently, right now, or in the next couple of weeks, or not at all, no, won't crash, or 3, that it will. It's not a matter of if it will or not, it's a matter of when. What's everyone's consensus here? 50-50, thanks Bill. Yep. Okay. Matter of when? Okay. There are big problems. We know that already. These problems have been there for years, but let's just highlight some of them. We've got Asian economies in crisis. China's growth rate is, if you can believe it, is not attractive. The European economies are in problems. Highly leveraged companies are on the brink. A lot of them are at high risk of bankruptcy. We've had huge problems already in the European financial system, and that filters down. We don't know what the long-term issues of Brexit are going to be. It's still a problem that we've managed to manipulate out of the market. You know, Brexit happens, market collapses, all of a sudden it's rosy daisies, and markets rally up again. If you think that's because retail buyers thought it was a great time to buy, I don't believe that for a second. We're creating more and more bubble every single day. When that bubble bursts, you're going to see the fallout like we did with Lehman Brothers. That's where you start to get bankruptcies. As you get bankruptcies, credit tightens. You know the story. What are we seeing right now? Those are kind of some backdrops that have been there for a while. What's happening more recently is where we start to get, we start to come away from the what is the problem. We know what the problem is, but when does the problem become imminent? So these are the things that have been happening recently. In March, Bank of America, Merrill Lynch, produced a report that said that essentially the market has seen the longest and strongest exodus in terms of people selling off their equities or equity redemptions. There's a 5-week streak, strongest and longest selling streak since 2008. That was when the market was rallying. Smart money has been selling off in droves. That's one risk. Why? Because of course they see the bubble. The estimated size of the bubble is $600 trillion of estimated value in worldwide derivatives. That means how much gamble, not based on, you know, a brick and mortar, here's a stick of gold, this is worth this much money. I mean someone having a stick of gold and someone betting that that stick of gold will be worth twice as much. The size of that bet is the size of $600 trillion in the market in terms of betting on where things are going to go, not actually owning the things themselves. That's scary. That is more entire real estate value of everything on the earth combined is not that number. Smaller than that number. P/E ratios are into question. If you look at the Shiller index, Shiller is a kind of a good P/E valuation of looking at whether things are overpriced and so forth. If you look at the Shiller P/E ratio, you'll start to see that the areas that are at their highest levels of Shiller P/E ratio, I believe it was about 49 P/E ratio, is real estate. We're right back to where we were again. Real estate companies have been are right up there. If anyone who's been tracking this has probably been making a lot of money. Companies like SPG, for example, which is one of the stocks that we recently alerted as a put. Simon Property Group. So we'll take a quick look at this. As you can see, this is a REIT. This is in the retail sector. Simon's Property Group rallying up in an upward channel. For those of you who don't know how to trade upward channels are an uptrend, but the way that we trade them, they are a bearish pattern. In other words, over 65% of the time, sometimes more, you will see that will actually reverse. It'll break down. So when I see an upward channel, I'm waiting for the break to short it. Now that pattern breaks down after 3 tests. 1, 2, 3. We call it the rule of 3. After 3 touches, we break. So 1, 2, 3. There we go. There's the shorting opportunity. That was when we actually alerted it as a short for the 2/10 November puts. And as you can see, that's done very well. If you want to look at, and we'll talk about money flow shortly, but money flow flooding out of the stock. If you look at other companies that have not yet fallen, you can look at things like KBH Homes that came up in my scan last night. This one is one of our newer alerts. Have a look at the pattern here. Let's just simplify this. You can see we have a head and shoulders here, a complex head and shoulders. You can see that underneath that we have a support system, kind of like a midline and a channel. And then you can see the breakdown below resistance that's occurred over the last few days. KBH Homes, also money flow diverging out the back door. We'll talk about that again soon. So these are the kinds of things where these high P/E ratio corporations are already getting slogged. Investors are taking their money out of high-risk opportunities that are selling at these unsustainable price-to-earnings ratios. The risk on trade is not good. Companies are cutting back. They're going into survival mode. They've stopped spending money. There may be more jobs available, but people aren't hiring for them. They might be available, but they're not being filled. And if you look at the way the market's reacted to all of this, it's been March madness or market madness. In March, after this market completely crumbled, we started to see that it rallied right back as if nothing was happening. So are we in a bear market or simply a short squeeze? A bull market or simply a short squeeze? The thing that I would ask you is, we've all heard this quote before, right? The theory of insanity is doing the exact same thing again and again, expecting a different result. Well, I'd ask you the question that if we are seeing every single red flag almost exactly the same as every single market correction we've had since 2006, and every single one of those red flags is saying the same thing right now, wouldn't that be insane to ignore it? Now, yeah, would you agree? No, I'm not trying to be a fearmonger. I hope I'm not coming across that way. I am passionate about this, but I'm not trying to say, look, go run for the hills, fill your basement with cans of beans and lock down. No, I'm not saying that. And I'm still trading bullishly. My top picks last night were all longs and a couple of shorts actually. But so I'm not saying the market's going to crash tomorrow. But I'm saying that if you agree that these are major threats that are coming along the horizon, wouldn't it be prudent for us to start planning for it? You know, how many people have seen the movie The Big Short? Great movie. That's actually, I've been trying to get my girlfriend, who I've been with several years, she's heard me talk about trading all day long, every day. I've been trying to get her interested in trading since the day I met her. You know, it took The Big Short movie to get her interested. She watched that and said, "This is fascinating. Can you teach me now?" I said, "Finally. Okay, good." The Big Short talks about people who, in the housing bubble, looked at the markets and basically are saying similar things to what I said. They said, "This doesn't make sense. Everyone on TV, including Ben Bernanke, is wrong. This is a huge bubble, and they are, you know, basically BSing the entire population. Now, we haven't figured this out because we are more intelligent than anyone else. We've just simply looked at the numbers and said they don't make sense. 1 plus 1 doesn't equal 10. And then they acted on it because the system, the mathematics, did not add up. And that's what I'm going to argue to you now. Not what my opinion is, not that I'm any brighter or smarter than anyone else out there. In fact, in quite a lot of times I'm not. But when I look at the math, this is what I see. When I look at the rules, it tells me that if I look at the market rallying in March, as hard as it did, this monster rally that began in March, and I say, right, if the market's really recovering, where is this buying coming from? And I go and I look at the insiders, because these are the people that know it better than anyone else. These are the people that are sitting around on Friday nights having scotch, talking about their balance books of Apple and Amazon and Google together, and knowing where the economy was really going because of trade levels. Those people sold the hell out of the rally in March. Those people sold the hell out of the rally in April. The red is selling, by the way. If you thought of these as candlesticks, who's in power here? In some cases, these ratios are 300 to 1 selling to buying ratios. This continues in May, right? This continues in June. Right? What would you think if I came to you and I said, you know, you got to try these diet pills. You got to try these vitamins. They are so amazing. You really should buy them off me, because I don't want them anymore. Would that be a very convincing argument? Sure as hell wouldn't. It sure wouldn't be. So here's all these insiders saying, no, the market's fine. Things are great. Negative interest rates. People are going to be buying this forever. But the people who own the companies you're buying are selling their own stock to you. September. Have a look at that. It's a scary picture when you start to get, when you scrub away the fluff of what you hear on TV, the conjecture about what's going on. Just look at what the smartest people out there are doing. Because I really don't care what I think. I want to know what they think. And that's basically a summary of the last 90 days of what the biggest, brightest, and wealthiest people are doing. Let's go, you say, well, maybe this is just small companies. Maybe this is just a random event. Well, let's go and look at the insiders themselves. These are a couple of articles I pulled out of Yahoo Finance last week. I wanted to share with you. If in case you weren't aware, let's look at some of the people that have made their billions of dollars by knowing market trends, by knowing when to get in and out. I mean, don't worry about the guy that's made $50,000 on a stock trade. Think about the guy that's made billions of dollars because he's consistently right about most of his investments. Look at Carl Icahn. He's just increased his short position by 600%, betting as much as $4.2 billion that the market will sharply and suddenly. George Soros, one of the most successful hedge fund operator in history for timing market crashes, has made $2.2 billion bet that the market would collapse. Jim Rogers, $68 trillion biblical collapse. All right? That's what the smart money is doing. Let's say that we don't believe that, though. Let's go one step further. Let's say, you know what? But that's still opinions. What these individuals might be doing is still just their opinion, John. How do we measure this in an even more technical way than just looking at those numbers? Well, let's look at the technicals then, shall we, as traders? Let's look at what the market's doing in terms of how it's set up. This is something I agree with, and I read this, it jumped right out to me. You can see that the HSBC technician, a very severe chance of severe fall, talks about how we're seeing a very similar pattern and setup as we did in the 1987 Black Monday market crash. and he talks about the technicals right there. HSBC contends the head and shoulders shape, a visual representation of price, is one of the most powerful things to indicate a market top, and he's right. Let's talk about that. This is what I've been talking about since July of last year. I'd like to take you to the S&P 500 and show you where we're at. Okay. Let's go to a weekly chart and let's just very quickly look at, this is basic technical analysis. So, when you're trying to determine, folks, if you're trying to determine where a stock is going to go or a stock market is going to go, it doesn't matter. If you're looking at a chart, what is the most important thing you look at to determine whether to buy or sell and so forth? And if enough of you share what the most important thing is to you, I will in kind share with you one of the most important things to me, which is up to 80% accurate in predicting the S&P 500. It's 2 days of the month, and today is actually one of those 2 days that sets the market direction for the next few weeks. I'll show you how that works. If you're willing to share yours with me, I'll share mine with yours. Let's have a look. Support, resistance, trend direction, long-term trend. Scotty, you got it. Scott already knows what I'm going to say. You're right. All right. I know we need some more people to contribute there. We'll see. The first thing, one of the first things I look at is trend. Now, people say uptrend or downtrend. You look for what the trend is. Well, trend is okay. What we really need to do is we need to find support and resistance. Support and resistance. Okay. So when you look at the chart, you say, what is the system controlling where this goes? Is it a moving average? If so, if the moving averages are the system behind the stock, then these don't matter so much. Horizontal lines, trend lines, those aren't the most important thing, because what's in power, the support and resistance that's in power, is a moving average. And for example, here, the market was in momentum mode. If a stock is in a momentum mode, you use moving averages, right? Moving averages work. You buy when the 9 and 20 cross. If you're an aggressive trader, you may buy when the 5 exponential or 9 exponential cross. You'll look for the MACD to go to cross positive. You might look at RSI to go above 30, right? You might look at the stochastics. I'm just throwing some ideas out there what a momentum trader may use. Directional movement, ADX. Now that might be your kind of, those are common indicators that are quite powerful with momentum trades. Great. Now, when a stock is in momentum mode, a momentum strategy works. So you need to diagnose what type of pattern the stock is in to know what type of rules to use. If you are in that situation, we buy when something after, because we know support and resistance is the moving averages. Very simply put, we buy at support. When the stock is underneath the moving average, it is under resistance. We need to wait for it to break above that for it to be at support. So not only do we use different indicators, but the way we manage the trade is waiting for it to go above the moving average, because that is when it is at support. And a lot of people confuse that. They think that they're waiting for it to go up because they're buying confirmation. No, that's not what you're doing. It's not confirmation, it's waiting to buy support. That's the most simple rule of all. Buy support, sell resistance. If you bought it on the way down, because it's momentum, you would be buying resistance. Okay, now this is critical, because if you don't understand the differences of momentum versus oscillation, then you don't know what rules to use. You don't know what support and resistance is most powerful and where you should be buying or where you should be selling. If you don't identify what the support and resistance is, you don't know the pattern. If you don't know the pattern, you don't know the rules for trading it. And as you can see, if you don't know rules for trading, you'll never have success consistently. So it all comes back to some of these basic things. Now, when we apply to the market, you can see that we go from momentum and then we go to oscillating. As you can see there, as we go into oscillation, the moving averages stop working, right? And then we go into oscillation. Now moving averages don't work. MACD doesn't work. RSI, you do not use it for a break above 30. Directional movement, you do not use. It's a completely different strategy. And in this strategy, we're buying support on the way down because the horizontal is more powerful. We don't wait for the moving average cross because the moving average doesn't matter. We buy on the way down and we sell on the way up because those are the supports and resistance we have to look at. Applying that rationale to the S&P 500, you can see how we can clearly define we were in oscillation back in 04. The reason we go back to 04 is we want to go far enough back to see where one trend ended so we can pick up where the next trend began. This allows us to draw our trend lines in correctly because we know that this pattern ended there and therefore a new pattern begun there, and that's where we start drawing our trend line from. It's the most accurate way to get the correct trend line instead of something where you end up going, well, I don't know, maybe it's that, or maybe it's, maybe it's, I don't know, is it this? And maybe the trend line starts here, and it goes up that direction. What about that? Does anyone struggle with that, not knowing where to actually draw the trend line? And ends up with like all these random things across the screen? Yeah. Okay. So, let's push forward. So basically, that's where our trend line starts. Therefore, we know that that's resistance. We copy and duplicate that support. We go forward. This tells us that this trend ended there when it broke out. Therefore, from there on, a new pattern is beginning. We can see we rally up, sharply pull back, therefore we know resistance is there, break out above it, and then we form that powerful head and shoulder. Head and shoulder right there on the top of the market. We measure that from the top of the head to the neckline. That's how much we break down. We then have another head and shoulder, right? That's exactly where it broke down to. Then we know that pattern ended there, so we know to look for a new one. The next pattern then starts. We measure the head and shoulder, and that's exactly how much it broke down as well. Right down to 1,000. That's where then that resistance, that support then became resistance, and then we created an inverse head and shoulder, and that's exactly how much it rallied back up to. So basically, simply put, the most quote-unquote chaotic and unpredictable time in the market was actually behaving very well. In fact, you couldn't have asked the S&P 500 to be more predictable. It was 3 perfect measurements of 3 head and shoulders that made up the entire drop and recovery of the S&P 500. Not just how far it was going to drop, but where would it drop to, where would it rally back? Where would it drop to next, where would it rally back? 3 head and shoulder patterns. These are powerful things. And if we fast forward now to where the stock market is, you're going to see another scary image when we look at what's happening today. Again, another upward channel, and we've had 1 touch, 2 touches, 3 touches. You can see we break down. So, okay, so we need to do this properly. We'll measure from the top of the channel to the bottom of the channel. We extend this exact measurement to the breakout of the channel. That's exactly how you trade a channel. Wait for the breakout. How far is it going to go? The distance from the top to the bottom. Duplicate that. And there we go. That is exactly where the S&P 500 dropped to. And this was what I was talking to you about when we did our webinar in July and said, this market's ready to short. This was why. And so that was where our targets were to take profits. We rallied back up, hit resistance from beneath, and then we formed a downward channel. The downward channel then broke out. And usually a downward channel has 3 touches. 1, 2, should have been at least 3 touches before it broke out to the upside. It didn't. And because we know the rules of that, that means it's not a channel. It's something else. So what else could this be? Can everyone see the head and shoulders? This massive declining neckline, head and shoulders on the S&P that both myself and seemingly this gentleman at HSBC are getting so excited about. Okay? Yep. Now the reason why this is also so interesting is if you then actually go back and look at a Fibonacci retracement on the market from where we crashed. There we go. Just change this to, let's change it to red, and we'll make it a bit thicker. Okay, let's make this a bit thicker. So recovered back in 2011 up until current. These are the Fibonacci levels. You'll see that this is the Fibonacci comes right into play with where the head and shoulders would drop to and rally from. Where it should then break down to is basically 1300, which is also a Fibonacci level. So you can see that where I'm getting that from is the measurement of the head and shoulders, and then duplicating that beneath the breakout point. Okay, so let's come back. So that's what the technicals are telling us. One more technical indicator that is extremely valuable, and you can chart this. This is a great tool for understanding market bias. Is to plot the S&P 500 index versus the amount of stocks in the S&P 500 index that are actually above their 50-day moving average. So the 50-day moving average is considered an institutional buy point. If banks, smart money, smart investors, hedge funds, if they like a stock, there's 2 places where they buy it at, the 50-day and the 200-day. If the stock falls below these levels, it means that there's a very high lack of confidence in the underlying equity. Now, look at this chart. You can see that right before we crashed in July, or corrected, I could say, this is where there was huge divergence between the 2 setups. And then again, in December, you can see the stocks, the blue line, dropped sharply away from the S&P 500, and that was right before our second big correction. When we had the big market rally, the stocks diverged away from the S&P 500 very early. And now, once again, you can see that we have had a even sharper than ever before divergence. The statistics on this I was reading, that there's only actually been 3 times where this has not predicted at a minimum of a 10% drop in the market. Now, this might not happen now, but I sure as hell aren't going to argue with those stats. If someone says 80% of the time this works, it works really well, then I'm going to listen to that. So we don't have a lot of time left, but this is basically where I think that there are these huge warning signs in the market. And And what we're seeing is that these are all lining up to create a potentially fantastic shorting opportunity, whether it's only a 5 or 10% drop or whether it's something much larger and that Head and Shoulders ends up panning out. Now is the time to really start thinking about what are we therefore going to do to profit from these market conditions. So I'll ask you this question as well. When you sit down and think about what are you going to look for to go long today or short tomorrow, do you have a strategy that is specifically looking for certain things? For us, I believe that you absolutely need a strategy. You absolutely need to say exactly what you're looking for. And that means, think about it as a recipe. If I was to say to you, like, what do you want as a perfect short? You tell me, I'll go find it for you. See, if you asked me what I would look for, I would say, okay, well, I want the most probable pattern. I want to find, if I'm looking for a short, I want to find stocks that are in a Head and Shoulders pattern, right there. You know what else? I want to see that stock has a price to earnings ratio of over 100. Higher the better. 500 price to earnings ratio. Yeah, find me those. Okay, these exorbitantly high P to E ratios. Let's find those. You know what else? Let's find stocks that have not only a super high P to E ratio, but stocks that have insiders flooding out. They're selling loads, millions, tens of millions, maybe even billions of dollars worth of their own stock right now. Not just the CEO, but the chairman, the senior vice president, the general counsel, the ethics officer, everyone. We want them all to be selling right now. We also want to see that they haven't sold hardly anything ever before until right now. We also want to go look at their track history over the last 10 years, and we want to see that those insiders that are selling right now, last time they sold and the time before that, it resulted in a 20-30% drop in their company. In other words, we want to see guys that seem to know when they're about to plummet. Let's get high track records. Now let's also see that they're in a sector with the highest amount of insider selling, with the weakest fundamentals. What else? Let's make sure that they have 5 times more debt than equity. Let's throw that in there. Do you see what I'm getting at? If I was to be able to find 10 stocks for you like that every day, would you be interested in that? Would you be interested in those as a short? Of course you would. So that is exactly what kind of what I'm driving at. Is this is the time in the market where you really want to be vigilant about finding the perfect shorts, because these are already dropping well before the market catches up, as you can see in the previous slides. And that's what I'd like to offer you today. What we're going to be, what we're conducting right now is as a special course that is all about scanning for these opportunities. Now we're not restricted to just simply longs or simply shorts. We are looking for longs as well. We are looking for all types of patterns, but we want to be efficient. We're looking for when we have, if we can scan for the ideas that make us the most amount of money in the least amount of time. Why spend 6 hours a day to make 10% of it when you can spend 30, 40 minutes a day being efficient and make almost the same amount of money? So here's the opportunity. I'll go over this. I think I'm pretty much out of time here. As you can see, I love to talk. But I think we have another presenter ahead of me. So let's, I'll go over this quickly for you. It is a 4-module course where we will be learning how to scan for the highest probability setups. We will be teaching you how to scan the market. You can use, we give you the criteria to program into any platform. We will show you the 5 steps I mentioned earlier to decide when you get that scan result which one is the best trade. We will be showing you, teaching you 5 very powerful techniques. How to scan for when these insider setups. So what I just talked to you about before, about that perfect list of shorts, that is exactly what we teach you. That is the exact scan that also found us Lululemon. Lululemon, we were students to buy puts on that prior to earnings. It was an upward channel, it was breaking out, or it was the #1 stock in our scan on the Tuesday. That's up over from $3.90 to over $19 today. We teach you all of those. As a bonus, options during earnings, that's an awesome strategy, very applicable for now. And as a bonus, we know that it's going to take some time to learn the scans. So what we've actually done for you is we've recorded a very special video. It was probably about at least 20, 30 hours of research last week that went into this, and we published a very special report with our absolute favorite shorts that we're looking at right now, with entry, exits, stop losses, options, everything. You will get that as a bonus that you can sign up, you'll receive in your email upon registering. You'll get 2 live classes to review on Tuesday, Thursday, and the final bonus is we'll also include for you a one-on-one training session with us to help you learn the strategy and make sure you're analyzing the scan results correctly. So all of that is included for the $97. I'll have to wrap up here, folks, so I'm sorry if I didn't get to all of your questions, but I will leave that scan, that information up on the screen. If you have any questions at all for me, you can also email me. I'll just go run through these. Are all the there you go. There's our information on the screen. Email us or give us a call if you have any questions. And I'd like to thank everyone here at Investors Inspiration for Market and MTI for holding such a wonderful event and having me on again. And I hope that you'll give us a go. And this is great content, and this is the absolute right time to be learning this. Don't miss the opportunity. So thanks again, and I hope to be seeing you all soon.